All right, Patrick, we're back on the Bet Out of Debt show. It's time for us to do what we normally do on a Sunday morning, but this time we're actually doing it on a Saturday night. This show is pre-recorded. We typically do this show live at 8:15 a.m. Pacific time, but because of some obligations tomorrow with me interviewing the lead attorney, and it's at the same time we had to bump this to Saturday night, and we'll post this tomorrow. How are you doing, Patrick?
I'm doing very well. I'm very busy during the tax season. We have a lot of filing deadlines. A lot of clients have flow through entities, and right now their individual tax returns are coming up April 15th.
Now, for those of you guys who are new to the show, Patrick is a tax accountant. And so he brings a good perspective to the show. And that's me. I'm Troy. I am a perennial investor as well as other business ventures. So, Patrick, let's get into today's show. Buy the dip. Are you buying the dip, Patrick?
Right now, I'm just kind of holding steady. So I'm not really doing much of anything because there's so much uncertainty in the market right now with the Federal Reserve set to rise interest rates 6 times, as well as the geopolitical risk in the Eastern Europe, Ukraine versus Russia.
Gotcha. That market volatility is out there. I think it's a good time to purchase if you want to step out there and buy the dip. I think you need to know what you're doing when you're buying the dip, and that's what we're going to talk about today. Some things to consider, not blindly buying the dip, but just taking some things in consideration and buying the dip. So, Patrick, let's talk about a stock that has fallen a lot, but now may be a candidate for buying the dip. And we talked about this show back in December. It's a stock called Rivian, and it's a popular EV company. Do you remember this, Patrick? On December the 19th, we featured this particular company. It was the rage of all of 2021, Motor Trend Truck of the Year. And so we talked about this. If you go back to the December the 19th show,
Rivian has a lot of hype. I'm
you'll
showing
hear us
right
talk
now.
about this.
Look at Rivian, the R1T truck. It's Motor Trend Car of the Year.
And we
This
talked about all of the
has to
hype
be a
there,
good
right,
company
Patrick?
to invest in, right, Patrick? I mean, look at
Yes,
the
we
hype.
did.
One as a
We
new
Hype,
investor would come
hype,
in and say,
hype, and we warned
all of the analysts are
we
talking
warned
big.
the people who followed us about that particular stock. So go to our December the 19th out of the broadcast and see what we had to say about Rivian. And you obviously can see we thought it was a bunch of hype. Just giving a refresher, RJ Scaringe, he was talking about meeting production demands. And let me play an interview from that show on December the 19th. RJ Scaringe, CEO of Rivian and founder of Rivian. And we did a real big, nice expose on RJ Scaringe back on that date. But let me refresh your memory with what he was saying, and then I'm going to play something from today. So check this out, Patrick.
And R1S pre-orders.
Now, this
in
is
the
from
US and
December the
Canada.
19th.
Are you worried when Ford says, hey, we've got 160,000 reservations for the F-150, the Lightning electric truck?
I think the key here to recognize is that when we launched the R1T and the R1S, these are our flagship products. These are the tip of the spear for us as a brand. And we really think of them as almost opening a brand umbrella for us. And as that brand umbrella opens, we'll add a whole host of different products underneath that umbrella, different price points, different segments, different form factors, of course, lower price points. And key for us as we come out is that these first products, the R1T, R1S, are really establishing the brand. And for us, we've got so much backlog that we're just focused right now on making sure we execute these products. I get a lot of notes from customers saying, "Hey, we're super excited. When can we get our car?" And so we're very focused on that. And of course, in parallel to that, we also have our commercial vans. And I think often it's perceived that there's some level of decision one versus the other. Fortunately, we've designed the business to run multiple programs at the same time. We have two very separate, completely independent production lines for those two products. And that's what we've been building, as you and I talked about a couple of years ago. That's what we've been focused on building is the organizational discipline and scale to be capable of running.
So Patrick, RJ Scaringe, the founder and CEO, was talking about production and just trying to keep up with that demand. Were we skeptical, or we thought he could hit?
I believe we were fairly skeptical about this.
We were very skeptical about this. And one of the things we played on December the 19th, and this is going to go somewhere in a moment, we played this, Patrick.
He also is expected to face production challenges as he tries to be the first. Now check this out. He tries to turn out 3 models, new models, while building and operating new sales hubs instead of relying on traditional car dealerships. So he's going to try to come out with 3 models, build new factories, and I question his experience. Now look at this bottom risk. Operational and functional risks abound. This analyst said in a note published this week. Ramping up production of 3 new models concurrently has not been done before. Thoughts, Patrick?
So that was back on December the 19th. And we were like, who is this RJ Scaringe guy? Who is this guy who is trying to open this new automotive EV, which is electronic vehicle company, launch 3 models at the same time, build 2 factories at the same time, and does not have that particular background in running a company? So we were very skeptical. So, I mean, that was an easy call with everything that was out there. And guess what happened, Patrick? Last Thursday. Not this Thursday, but a week from Thursday. Guess what happened?
What happened?
Rivian missed their numbers badly. And when we did that show back in December, what was Rivian's stock? What was it around back then?
I think it was around $90 a share or so.
It was about $98 or so a share. Now, check this out from a week from this past Thursday. What happened with Rivian's?
Mike, they're getting hit hard because there's little to like about this Q4 report from Rivian. It is a miss on the top and the bottom line with a loss of $2.43 a share. The company has 83,000 reservations now. That is an increase from 71,000 in December, but they only produced a little over 1,000 vehicles, delivering 920 for all of 2021, basically in line with their previous guidance. But then when you look at 2022, they say they're going to have the capacity to build 50,000 vehicles this year, but they only expect to build 25,000. Why? The supply chain. They are blaming that on the lower than expected production, or lower than some people were expecting. As for 22, they are expecting an EBITDA loss of $4.75 billion, CapEx of $2.6 billion. They ended the quarter with $18.4 billion. Guys, we're going to jump on the conference call, see what RJ Scaringe has to say, but not a good report from Rivian. Guys, back to you.
Patrick, anyone could see that coming a mile away. And you know what I have to say about that?
Hell no, to the no, 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 hell to the no.
So Patrick,
We saw that train wreck coming. That was a slow motion train wreck.
it's an easy train wreck to see, very easy. But the point I'm trying to make here is just because the stock is way down, let's do an evaluation to see if you should buy the dip, because not all dips are worth buying. Have you ever heard of this term, Patrick, called a falling knife? Would you like to describe that for our audience?
Yes, so a falling knife, that's where a stock or a security just keeps falling and falling and falling with very little support.
Right. It's a value trap. It's a value trap.
And God only knows how low it's going to go. I I mean,
Right.
everybody who thinks, oh, it's just a great company because it's so cheap, they end up being wrong.
Right.
Trying to catch a falling knife, they get cut.
They get cut. So they try to catch a stock, they buy the dip, and it keeps dipping, and they buy, and it keeps losing more money to the point where you sell low and you lose even more money than before. So Rivian's way down, Patrick. Let's do a valuation on Rivian. Let's see if Rivian is actually worth buying at these levels. And I'm on Yahoo Finance, guys. Let me put Rivian in here. And let's put up the ticker here. So, Rivian didn't come up, Patrick. Let's try. Oh, there we go. That's the right ticker. So let's pull up Rivian. Rivian's gone up over the last few days or so, just before closing. But so we will go to the summary chart. The first thing we're going to look at Rivian in this inflationary environment to see if Rivian is actually making money. Because in this inflationary environment, Patrick, I'm kind of leery of investing in any companies that's not actually making money. And the way we can tell if a company is actually making money is just really looking at the EPS, the earnings per share. And if that earnings per share is negative, Patrick, what does that mean, my friend?
That means the company's losing money.
Absolutely. The company is losing money.
As well, if you look at that PE, you see it says not available.
That means
there's no
it's
earnings.
That's right.
There's no earnings.
There's no earnings. It's losing money. And earnings, as we know, is a
you
fancy
can't
name for
that.
profits. Exactly. It's a fancy name for profits. There's no earnings. So that in itself is risky, investing in a company, buying the dip in a company that's losing money. So we're not doing that. But then look at the price to sales, Patrick. We want the price to sales for a company to be 10 or less, unless it has incredible growth. And so look at the price to sales. Even though Rivian has fallen all the way from like 179 when back in 2021, because it shot up quickly and then it fell like a falling knife. And even though it has fallen so much, look at the price to sales, my friend. Let me share this. Look at the price to sales.
Oh, that's disastrous.
27 times sales. Again, guys, me, price to sales, I want those companies 10 or less, and preferably 5 or less. So this is a really expensive stock, even though it has come down a long ways from where it was. And so maybe there's a justification to buy this stock, Patrick, because of the growth rate. Because if the growth rate is high, people would take risks on these type of companies, even in this inflationary environment. So, Patrick, let's go and look at the growth rate for Rivian. So there must be some justification. We go to analysis. We go to the bottom of the screen here, and we look down here at the estimated growth rate. So this current year, Rivian is projected for 59.9%, 60% growth. Do you believe that's actually going to happen?
No.
I don't think so either. They're having production problems. We just covered that. They're having production issues. How are they going to have 60% growth? They just said, you know what I'm saying. That's crazy. So then next year, and the next 5 year per annum, which means each year compounded, they're projected to lose 100%. So that makes no sense to buy a company, even though it's this cheap looking in price. If the price per share has fallen so much, it still doesn't make a lot of sense, Patrick. You know, it's not making money, and the metrics is all off, the price to sales as well as the growth. Thoughts on that?
Yeah. Well, you want your price to sales to be cheaper, like below 10. and you got to have a PE ratio, at least have a positive PE ratio, positive growth, and have some making money, and especially in this inflationary environment with all these risks that are out there in the system. So this is something that you want to avoid.
Yeah, it's something that I wouldn't buy in this environment. And for those who like the Rivian truck, that's fine. But for me, you can decide. So let's look at another stock that I was checking out for the Bet Out of Debt show. And this company has fallen a long ways as well. And that is Shopify. So I'm going to pop shop up here, Patrick. That's the ticker symbol. Let me put that up on the screen. I'm using Yahoo Finance again. And let me see if I can blow that up on the screen. Shopify was like above $1,500, $1,600 a share. You can look down here to see the 52-week high. Let me blow this up. Before it fell recently, it was at $1,762 a share, right?
Yeah, that's probably like, I see that. That's probably around mid-November.
And I can't pull the charts. The charts are misbehaving, and I don't want to go to bar chart. I just want to make a point here. But now the stock is all the way down to 780. It was actually lower earlier this month. It got down to 510. The stock had really fallen, right? And so, but here's the point. The point is, in this inflationary environment, you want to buy companies with positive earnings, number one. Number two, you want to look at the forward PE, and you want to buy companies with a forward PE less than 30. Preferably 20 or less, but less than 30 for a tech stock is really good. And then all other stocks, less than 20 is even better. So Shopify, what do you consider this, Patrick? A tech stock? Is this like a PayPal type interface?
Yeah. It's online shopping.
So
predominantly, there's no brick and mortar.
So look at this, Patrick. Let's look at this, and let's look at Shopify here. Look at the earnings, the EPS. We're looking good. It earns $22 per share. That's good news, right? This is the trailing 12-month PE. So what we really want to do is go to the statistics tab. And then go into the statistics tab. We want to look at the forward PE. The forward PE is what is the price of the stock in relations to what is projected to earn. And look at the price of it as projected to what it's going to earn in the future, the forward PE.
So 227 times.
And what did we say earlier? 30 or less. So,
right.
People look at these type of stocks and see, hey, Shopify fell all the way down to $510 a share. And then from $510 a share, it moved back up to $780 a share. But Shopify can fall a lot more because according to its PE ratio, it's still, and we're talking forward PE ratio, it's still really expensive compared to what it's projected to earn in the future. 227 times what the company earns forward is expensive. So would I invest in a company like this, Patrick? Would you?
No, absolutely not.
It's
too expensive.
It is absolutely too expensive for me. For you, it may not be. For me, for Patrick, yeah.
Yeah, it's expensive for me.
Yeah, it's too pricey. So I want our audience, when they go to buy the dip, they're not just looking at how far the price of a particular company has fallen. I want them to also look at the metric. Look first on the summary for the EPS, then go to statistic. Look at the forward PE. You want to see 30 or less. And then you want to look at the price per sales. You want that 10 or less. And you want the PEG ratio to be around 1. This is not applicable because, and we'll get to that in a moment, the growth, this is just so big compared to growth you'll see in a moment. So let's go look at the growth rate. Because if I'm going to take the risk, Patrick, to pay 227 times earnings, then what I would expect is for a company to be growing like crazy to justify that amount of risk. Agreed?
Like hundreds percent, literally hundreds percent.
Exactly. So let's go over to statistics and let's look at analysis. Let's go to the bottom of the analysis page on Yahoo, and let's go look at. Am I on analysis? Oh, I'm still on statistics. That's the problem. Let's go to analysis, and then you go to the very bottom. Just go right to the very bottom and look at that expected growth rate. Now, next quarter expected to grow a minus 58%. This whole year, a minus 43%.
Hell no, to the no, 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 hell to the no.
And then next year, over the next 5 years, this is good, Patrick, 40% per annum. So compounded 40%, I would say 37.95. Let's just be exact. Year over year, over the next 5 years. But do you think that's worth 227 times earnings?
No, absolutely not. Because you look at NVIDIA, which is always going really well and always outperforming. That stock is around maybe 50, 60, and that's even expensive.
Right. And we can look at that. So let's juxtapose our audience with the stocks that I would buy down here, the dip that I would buy, not catching a falling knife because I don't want to hurt these big, beautiful basketball college playing hands from back in the day. So here's a stock to consider based on the metrics that we just talked about, Patrick. Let me pull up a company that we have been haranguing and just singing its praises on cheap and it's a good value. Okay?
Yes.
All right. Let me get that up here. Let me put the ticker in and I'll put a screen over. Let's talk the Ford Motor Company.
Yes.
Now, one could do Tesla too, because Tesla is a pretty popular company, but you can do that on your own for what we was just talking about. But let's look at the Ford Motor Company. And again, I'm on the summary right here, and I want to make sure it has positive earnings. So $4.45.
Yes.
That's trailing 12-month earnings. That's good, Patrick. That used to be $2, so that's more than double. That's really, really good. I remember last year, if you go back and look at some of the older Bet Out of Debt shows, you would see that number was $2. So we have like double growth here for the Ford Motor Company. And you can go look at some of the older shows on Ford. I'm not going to go into all of the incredible things that they're doing. But if you go back and look at the 2021 episodes we've done in Ford, you will see why we're so bullish on Ford. I mean, we really go into a lot of details on these guys. But look, Patrick, EPS 445, so they're more than double in earnings. So share price should double based on that. At least contribute to doubling. Look at the PE trailing 12 months. That's the trailing 12 months. That's not the one we want to look at, Patrick. Which one we want to look at, my friend?
You want to look at the forward.
Right, and that would be under statistics. And I know I'm being a little repetitive, but this is for our newer investors. Look at the Ford Motor Company forward PE.
7.6 times.
7.6 times earnings. Not only is it less than 20, not only is it less than 10, it is less than Well, it's not quite less than 5, but it's good, right? So, and then look at the PEG ratio, Patrick. We want the PEG ratio to be 1 or below. For tech stocks, we want 2 or below. This is 0.37. So this is really, really cheap stock. Now, look at the price to sales, Patrick.
0.47.
0.47 times the sales. So those are the kind of metrics you want to look at when you're looking at catching a falling knife versus buying the dip and getting the results that you expect. So now we're looking at that, and we're looking at this forward PE, and we're looking at less than 1 PEG ratio, and we're looking at price to sales less than 10, even less than 5, even less than 1. There got to be something wrong with this company, right, Patrick? There just has to be something wrong with this company, right?
Yeah. What's up with that?
What's up with that? So then we go back and we look to see what's up with that. And we would click on analysis right here at the top. And then we would go to the very bottom. And then we will look at the expected growth rate. So next quarter, this current quarter, it's going to lose money. We had the chip shortages and all of that. And these are estimate, guys. So this could be incorrect. So let's slow our roll for a second. Let's pump the brakes. But next quarter estimates 300%, Patrick. Current quarter, current year, 28% growth. And then next year, 12%. But look at per annum over the next 5 years, what is projected to grow. 74%.
That's stupendous.
So you tell me at $16.86 per share, the 52-week high for this company was 25. The 52-week low is 11. It's trading at 16. And we just showed you it's earning money. And if you look at our past shows, the EPS has more than doubled. It's a no-brainer, Patrick. These are the kind of companies you want to buy the dip on, is the point. These are the kind of companies I would buy the dip on. Some may disagree, but that's my story. What do you think?
Yeah, I mean, you can't argue with those metrics. I mean, the double EPS growth and the compression of the price to earnings. So that means the risk, where if there was ever a bubble in that stock, which there really wasn't, because the stock hit an all-time high of 25. Right now, it's trading at 16 or so. Amid all of this risk that we have. I mean, you've seen stocks that are declining 30, 40, 50, 60%, 70, 80%. This is only down like maybe 20, 25%. And it's still very, very cheap. And cheap in terms of metrics and cheap in terms of dollar cost.
Now,
and of course,
ahead,
you have an exciting CEO, Jim Fowler.
Yeah, Patrick, people need to go back and look at those past Bet Out of That Show episodes on Forward. And since then, they have come out with more bullish growth theses that you can get behind for why one would be interested in this company space. And they're just doing a lot of exciting stuff. And like you mentioned, the CEO, we went into a lot of that in 2021. I just encourage you guys to go back and make an informed decision for yourself and just search the internet for this stuff. I mean, it's all out there. You do not have to be a stock genius or anything to see this information. You might need to be a geek like me and look at Bloomberg, CNBC, Fox Business, and all of that type of jazz. But, we're here to help you, get that type of information. So the Ford Motor Company is a great option. Now, can I give you another good option, Patrick?
Yes, let's do another good choice.
Okay, so let me pop up another stock that we talked about recently. And
I'm sorry.
yeah, don't worry about it, Patrick. Let's pop up another stock that we talked about recently, and that is the stock of one of our faves. Who's our favorite lady CEO?
Dr. Lisa So.
Dr. Lisa Su's stock, AMD, Advanced Micro Devices. Here's another stock to consider if you're buying the dip, something I would consider. So what's the first thing, Patrick? We want, what do we want here? We want positive earnings per share, correct?
Exactly.
And so look what we got here, Patrick. We have an earnings per share of $2.57 per share. So that passes the first test. No negative earnings, no losing money in an inflationary environment. We really don't want that. Okay, test number 2. We got to look at that forward PE, that forward price to earnings ratio, and we want that below 30 for a tech stock. And look what the forward PE is, Patrick.
It's F25.
Ooh, I love that. Do you know tech companies, semiconductor companies, can trade upwards of 40 and 50 times earnings? That's juicy and sweet. All right, and then look at the PEG ratio. For a tech company, we like those to be below 2 on a PEG ratio basis. That let us know how expensive our forward PE is. And the PEG ratio is 1.33. That's really good for a tech company. Look at the price to sales, Patrick.
Price to sales is 7.8.
Really good company at this price. And now let's look at the growth rate to make sure all of this stuff makes sense, because when we're buying a stock, we're actually buying growth. We want that earnings per share to continue to grow over time, which makes the stock price grow over time, right? So let's look at the estimates. Look at this, Patrick. So next quarter, 58%. Current quarter, AMD is projected to do 73% growth. Next quarter, 58%. This current year, 43%. Next year, 16%. But per annum, 30% growth year over year. At these prices, Patrick, are you a buyer?
Absolutely. I mean, and then you listen to the conference call, and they've just blown away every single estimate and completely impressed the analysts during the conference calls.
Exactly. So, I mean, these are no-brainers as far as a metric standpoint. But then one has to always keep in mind, is there other risks out there that you're not considering, and that, fundamental risks, what is this whole Ukraine risk, all kinds of things happen, the China risks. So you have to look at everything related to the company, but from a pure metric fundamental analysis perspective, these are the companies you want to look at and consider to invest in buying the dip. So I guess that's kind of what we wanted to share today. We wanted to share buy the dip. You better shut your lip and be careful and watch those metrics to make sure you're purchasing the right type of company to get the results that you want. And you know what, Patrick? This is the risk mitigation game. This game is about reducing risks because no one really knows what the market is going to do. So we're like a casino. We're playing the odds here. And the odds are you're going to have a better chance making money and having better results in evaluating a company versus just looking at the price of the stock falling 50%, 70%, and saying it cannot fall any further, or this is a great company, or Rivian is Motor Trend Car of the Year, so this is a great price. Yeah, we just showed you it's still very risky, and it may come back, but just too much risk for my blood, my friend.
Or ARK investment will never go lower, when in fact it's an ETF full of companies that are losing money.
Exactly. All right, Patrick. Well, I mean, I think that's kind of what we wanted to show today. Just I hear a lot of talk about buying the dip. And I was looking at my friend's show, the lead attorney show, just this week. And he was talking about buying the dip, buy the dip. We're all going to be rich buying the dip. And I believe we all will be rich buying the dip on the right companies. So with that
on the
said,
right companies, that's the key.
That's right. But I do agree with them. There's a lot of money to be made buying the right companies. So that is the Bet Out of Debt show for today. We call this show the Bet Out of Debt show because when you place a trade, it's called placing a bet, which is really a metaphor for investing. Hopefully, it's a winning one to keep you out of debt. And as always, keep investing. And we're going to be doing pre-recorded shows over the next few weeks. And maybe in a few more weeks, we'll be live on Sunday mornings. But I will continue to try to bring you content. I appreciate the support. And as always, hit me in the chat, comments, and reach out. And I'll definitely hit you back. So thank you and see you next time.